If you've had decent gains, should you take a little bit of money off the table? What is the strategy here?
Yeah, so we think there are more upside risks to US inflation than downside ones. That's in stark contrast to our view about UK and Eurozone inflation. We also think that US growth is going to slow down sharply this year, economic growth, although our base case is a recession is avoided. So what does that mean for our equity strategy? Well, it means that we do want to be invested. We're more or less neutral equity beta, but we continue with a strong tilt towards profitability and quality metrics, which tend to generate excess returns anyway, but especially when growth is slowing down. But you've got to want to keep an eye on valuation metrics. And our favored ones are free cash flow yield, price to sales, or price to book adjusted for intangible investments. And value strategies have outperformed growth-based strategies in pretty much every region around the world this year. So that blend of quality at a reasonable price, but being broadly neutral equity market beta is our strategy. To diversify, we like non-US bonds, commodity futures strategies, and we still have a position in gold despite the new highs.
Ed, the market commentators, including Karen and I, and including you, might have got something very badly wrong, that the market rally was premised on the basis that we were going to get these rate cuts this year. At one point, with the 6 expected in the States. And I take on board everything you just said about inflation being stickier. I agree with you entirely. Now that the market is expecting limited cuts from the Federal Reserve, might get 1, might get 2, you never know, might get none. It's still rallying as well. So what has replaced this obsession that we've all had with interest rates, with the continuation of the rally? And is it then built on actually more interesting fundamentals if it is potentially based on what have been jolly good earnings out of the States?
Yeah, I mean, that's a great question. So, I mean, like you, I'm surprised that the run-up in bond yields, the positive inflation surprises, or inflation surprising on the upside, didn't engender more equity market volatility. We saw a bit of that in April, as I said, but what's picked up the slack, what stopped the market from falling more, was a really quite decent earnings season. And crucially, a return of earnings breadth. So not just profit growth concentrated in a few mega cap names, which has been the trend for quite some time. So by breadth, yeah, that's a sort of jargon term, but I mean a number of companies that are benefiting from analyst consensus upgrades, less the number receiving downgrades. And that turned positive in April. And it's been mainly negative for 2 years. And then in May, that breadth improved further, and it hasn't been this strong since early 2022, before the COVID reopening tailwind finally started to fade. So we've had more of that earnings breadth. Now, where does this go? Well, we think that the earnings expectations had come back earlier in the year. There is now a lower bar to beat. But if the US economy does slow down further than people expect, that it goes sort of closer to 0 to 1% growth rather than 1 to 2% growth, which seems to be more the consensus by the end of the year, then perhaps those profit expectations could come under pressure again. But for now, it's that improving earnings breadth that we can't ignore. That's an important driver of market, and that's helping investors just put concerns about rates to one side. But that volatility, that rate-based volatility, could well come back.